Friends, in today's video, we are going to talk about the common mistakes that, if avoided, can help you earn better returns through lump sum investing. Most investors choose SIP when investing in mutual funds. But when you have a large amount to invest, you often need to consider lump sum as well. And when you decide to invest lump sum, then what are the mistakes to avoid and what precautions you need to take? By keeping them in mind, you can aim for strong returns while minimizing the chances of losses. That is exactly what we are going to explore in this video. The very first mistake that investors make while going for a lump sum investment in mutual funds is investing their entire investable amount in one go. The risk here is that if you invest a large lump sum amount and the market starts correcting, immediately after that, your investment turns negative right from the beginning. This not only creates heavy mental stress in managing the investment but also, in many cases, pushes investors to redeem their money, sometimes small loss or just at cost. So what is the right way to invest lump sum amount if not at once? The correct approach is to first park your investable amount, whether it is 20 lakh, 50 lakh or 10 lakhs, into a debt fund or at the most into a balanced fund. Then gradually move the money into equities through a STP, that is systematic transfer plan. Just like SIP allows you to invest regularly, STP works the same way. You systematically transfer from your parked amount in a debt or balance fund into an equity fund every month. This way, your investment gets averaged out, reducing the chances of facing a major drawdown or a big loss. Now, the number of installments you should divide your lump sum amount into depends on your risk tolerance. As a rule of thumb, you should spread it over at least 6 to 12 installments, transferring equal amount each month from your debt fund to your chosen equity funds, the ones you are targeting for higher growth. The second common mistake investors make while doing a lump sum investment is chasing high returns. They usually put money into small cap or mid cap funds, since these categories tend to deliver higher returns. Or alternatively, they invest in a fund whose recent performance looks very strong at the time of their lump sum investment. But this is not the right approach for lump sum investing. Before choosing a fund, you must assess your risk tolerance, or in other words, your ability to handle volatility. If you invest in small cap or mid cap funds, you will have to face more volatility risk. If you cannot endure sharp ups and downs in your investment, and if you prefer mental peace with decent returns rather than extreme swings with potentially higher returns, then small cap or mid cap funds are not suitable for you for lump sum investment. That said, if your investment horizon is truly long term, around 10 years, you may consider small cap funds. But be prepared for significant fluctuation in NAV along the way, because small cap funds are highly volatile. During a severe market correction, a small cap fund's NAV can fall up to 40 to 50% or even 60%. Unless you are mentally ready for that, you should avoid investing in small cap funds. A better choice for most investors would be flexi cap funds, or to some extent mid cap or multi cap funds. These offer growth potential with relatively lower volatility than small caps. Large cap funds, on the other hand, should generally be avoided for lump sum investment. Although they are more stable, their returns are quite moderate. Over 10 years, large cap funds typically average out around 12 to 14%, while small cap and mid cap funds often deliver 18 to 20% in the same period. That 6% difference compounded over a decade becomes a huge difference. So the choice is yours. If you are willing to sacrifice significant returns just to avoid volatility, you can go for large caps. But if you are investing for long term, that trade-off is usually not a wise decision. On the other hand, if your time horizon is much short, say 3 to 5 years or less, then a balanced fund or even a large cap fund can be a good choice. The third big mistake and one of the biggest obstacle in achieving your long-term goals in mutual fund investing is stopping your SIP or redeeming your investment when the market falls. This is the very reason that many investors fail to enjoy long-term growth in markets and struggle to achieve their financial goals. In reality, whenever the market corrects, you should not stop your SIP. If possible, you should actually step it up. Increase it by 5%, 10% or even 15% depending on the funds you have available at that time. Because during a downturn, you are investing at lower NAV, which means you get more units. When the market eventually recovers, you not only benefit from that recovery, but also from the large base of units you hold. That is how long-term investors generate superior returns. This is why understanding your risk tolerance, that is, your ability to handle volatility, is so important. Once you have decided to which fund to invest in, evaluated your risk tolerance and decided your investment horizon, the best strategy is to stay invested until your goal is reached. Don't exit in panic before that. Instead, use downturns as an opportunity to add more through SIP. Ultimately, if you stay invested for the long term, that is up to 7 to 10 years or more, the stock market and mutual fund adjust their volatility, and despite the ups and downs, at the end you get very strong returns. Take the COVID crash as an example. At that time, markets fell 30% to 40%, and some small cap funds even saw a decline of 50 to 60%. Yet today, not only have those losses been fully recovered, but investors' money has multiplied several times since then. So to sum up, your mutual fund NAV will fluctuate. But when you look at the big picture, after a proper investment period of 7 to 10 years or more, you will find that your mutual fund has generated excellent long-term returns. Now let us talk about a mistake that most people rarely discuss, but it can seriously affect your investment and your ability to achieve long-term goals. Suppose you have invested in the right fund through a staggered lump sum approach, stayed invested in the market, and your investment horizon is 10 years. But what often happens is when your investment is about to complete 10 years and when you are about to withdraw money for your goal, the market suddenly falls by 20% or 30% or even more. Imagine how you would feel if after your fund has grown significantly, you suddenly lost 30% of its value right when you needed it most. And this situation is not just hypothetical. Such corrections do happen, sometimes severe, as investors experienced during COVID crash. But the solution is simple. Do what you did when you first invested a lump sum amount. Back then, you parked your lump sum in a debt fund and gradually transferred it into a equity fund for long-term growth. Now, you need to reverse the process, starting from the 8th year of your investment or at the latest after completing the 9th year. You should gradually start transferring money every month from your equity fund back to a debt fund. By doing this, you protect your gains. Just you minimize risk during investment by staggering, you also minimize risk during redemption. If you wait until the very end and the market suddenly becomes volatile, the NAV of your mutual fund could drop sharply, wiping out a large portion of the wealth you built over the years and making it difficult to achieve your financial goals. So, if you follow this precaution along with the earlier ones we discussed, there is a high chance that your mutual fund investment will generate excellent returns and help you achieve your long term and short term financial goals successfully.